Good morning. Welcome to Market Monday. Last week, as widely anticipated, the Fed left rates unchanged for a second meeting in a row. As a reminder, its next meeting is over a month away on November 1st, where it's again likely to keep rates unchanged. Couple things. Does it really matter? Perhaps, maybe. And the rate hikes over the past year have certainly affected some things somewhere in some ways. But to our long-term investments, these investments are long-term, right? I'd argue there are better things to focus on. How much are we contributing? What's our approach for income? How are we getting our diversification? How are we balancing and managing the different risks inherent in investing? Speaking of, what are those risks? We all know volatility risk, the risk of investments or our account going down in value. That's the main one, front and center. But what about inflation risk? Meaning having your assets and income maintain purchasing power over long periods of time, decades. Even for retired clients, your investing life could be greater than 30, 40, or 50 years. Is a Fed decision today going to mean anything to you in 30 years? What about outliving your money? That's called longevity risk. There's probably no greater responsibility we have to a person than to make sure you don't outlive your money. So yeah, we're constantly juggling all of these considerations in addition to volatility risk when it comes to being good stewards of your hard-earned money. This is what we're talking about. This graphic was created for a life advice or self-improvement audience, and it's true. The past is the past. Let's not get too hung up on it. Let's focus on the possibilities of the future. But this applies to investing as well. On the left side, here we are born, or in our case, we begin our investing lives. Could be just starting to build your investment portfolio, could be the start of retirement. Point is, at that time, there are dozens, even hundreds of various outcomes the future could hold. As time goes on, however, there's only one path that was illuminated, the path that actually happened. Out of 100 different potential outcomes, only one happened. And looking back, it's so obvious. It really does seem that way, but it's only obvious with the luxury of hindsight. That whole hindsight is 20/20 thing. So when we get to this point, the one right here, this is now, today, the moment right now. And again, just like when you were starting out your investing life or your retirement life, there are dozens, even hundreds of potential future outcomes. These represent all those considerations I was just talking about: volatility, staying invested, growth, income, keeping pace with inflation, not outliving your money. And the markets, the economy, the politicians, the wars, the recessions, the technological advances, they're going to happen. That's a fact of investing. It's a fact of life. What are we doing to achieve an outcome at the end over here that's desirable? What are some of those outcomes for you in your life? One interesting path that's in the history books is the performance of 10-year treasuries. Although we still have a little over 3 months left in the year, we're on track for a third consecutive annual decline for 10-year treasuries. That would be a first, going back almost 100 years to 1928. Down 2 years in a row only happened 2 other times, both in the 1950s. And those other 2 times weren't down nearly as bad as the past few years. So predicting events that occur once in 100 years or 3 times every 100 years, again, we'd argue to focus on other things. Like, what is our strategic or core long-term allocation to bonds? Should we write the entire asset class off for good? Perhaps we shouldn't rely exclusively on them for our diversification needs, but perhaps they aren't entirely worthless either. Here are 6 prior hiking cycles showing the peak CD rate for those hiking cycles and the 1-year forward returns for various types of bonds following the peak CD rate. This is relevant because as we see the Fed pausing rate hikes, as long as inflation doesn't heat up too quickly, it's possible the Fed could be done hiking for this cycle, which means peak CD rates could be in the near future. Here we have CDs, short-term bonds, municipal bonds, core and core plus bonds, and investment-grade corporate bonds in purple. Doesn't really matter what you owned, they all went up. Many times double digits up. Look at this one here in 1995. Peak CD rate 5.69%. We're inches away from that right now. This was a mid-cycle reduction in 1994, meaning there was no major economic crash, just a course correction by the Fed after rates had grown sufficiently tight. Sound familiar? And the next year produced 15, 17, over 20% annual returns for bonds. What is our strategic core long-term allocation to bonds? And today we'll leave you with another clip from the mid-90s, 1993, just before the start of a technological revolution. Have a great week.
Is talking on the phone getting out of hand? Look out! You need phone relief, the ultimate in hands-free phone design. Watch. Simply attach the special double back fastener to any phone. Then attach the phone relief headset. It's that easy. Hands-free, pain-free. You'll wonder how you ever lived without it. It's perfect for remotes. Now talk hands-free anywhere, anytime. Office work is a pain for Mr. Phone in the Neck, but you won't miss a beat with hands-free freedom. A must for the entire office. Work goes quicker and easier. The padded headset removes this easily and is fully adjustable. Best of all, Phone Relief works with your favorite phone, an amazing breakthrough product you'll use every day. Now only $12.95. Call toll-free to order by credit card and make this your last Phone in the Neck call.